Hi, welcome to this week's 7 Market Movers video series from Wealth Enhancement. My name is Aya Yoshioka, Portfolio Consulting Director and Senior Investment Strategist, and we like to cover headlines that really grab markets' attention in these videos. And it's been a bit of a rough February to start. The S&P 500 index is down about 2% in the first few days of February. It feels like a lot more. Small caps are still up 3.8% on a year-to-date basis, but they also took a little bit of a breather this week and we're down about 1.4%. So, what caused these market moves and what really caught our attention? Well, starting with last Friday, President Trump announced that he's nominating Kevin Warsh to be the next Fed chair. The current Fed chair, Jerome Powell, his term ends in May of this year. So, what does Warsh bring? Well, Warsh has a history of being tough on inflation, or at least worried about inflation. And that alleviated a lot of concerns that investors had, just given the pressure that the Fed has endured over the last several months to lower interest rates. And a lot of people fear that these lower interest rates are going to cause another bout of inflation. On another front, earnings season continued, and we had technology front and center, just really moving markets. And it wasn't just earnings. So we had software stocks really being pressured this week. And it all started when Anthropic, the maker of Claude Code, announced a new legal tool. This really further fueled some of the fears in markets that AI agents would cannibalize workflows and that there would no longer be as much growth for these software as a service or SaaS companies, and that their business models were a little bit more in jeopardy than people had originally thought. We also had earnings from Alphabet and Amazon. Alphabet posted a really strong quarter, beating most expectations with their search segment growing 17% year over year and their cloud segment growing 48% on a year over year basis, well above the 30% growth that Wall Street analysts were expecting. But what really surprised investors was that Google or Alphabet guided that their capex spend for 2026 was going to be 175 to 185 billion dollars. That's well above the 120 billion expectation and almost double their 2025 capex spend of 91 billion dollars. And all of this money is going to continue to further invest in AI build out and deployment, all of the infrastructure that is needed for AI to continue to proliferate. Amazon beat on sales, but missed on EPS, and they guided the first quarter to below where estimates were. And similar to Alphabet, they also guided to 2026 capex that would be $200 billion. Again, just with these two companies combined, we're looking at almost close to $400 billion of capital spending that is going to go into the economy, really focused on data centers and chips. And all of this spending is great on one hand, but it's also a little bit concerning, I think, for a lot of investors. Gold had a huge January, and it was up almost to $5,400 an ounce, up almost 25% just in the month of January alone. But it has reversed. And since its peak, gold has fallen about 12% to slightly below $4,800. Silver has swung even more, and we even saw some action in crude oil. Crude oil had gone from the mid 60s to the low 60s, just given some geopolitical headlines. But US Iran tensions really eased in the coming days, and OPEC sort of stuck to its quotas. So crude oil came back down. Bitcoin also dropped below $80,000, and it's down 25% in these first few days, just in February. So enough with the bad news here. We did see some positive economic news. The ISM survey data that we get showed that the economy continues to expand. New orders were increasing, and we've seen solid business activity. So we just want to remind investors that market narratives can change really quickly. And we've gone from the everything rally to the sell America route. We've gone from AI is fantastic for everybody to AI is destroying businesses and business models. And even though we're here to dissect these headlines on a weekly basis, it's really important to remember that volatility usually is short lived, and that discipline and diversification can really be the pillars that we lean on when markets get a little uncomfortable. So, with that, thank you so much for listening, and we hope to see you next week.